All right, welcome back. In this segment, we're going to talk about how we can calculate product and customer margins, which, as I mentioned in the last segment, is extremely important because we want to make sure that the products we're producing are profitable and that the customers we are servicing are also providing a profit for our business. So let's get started. So our product margin calculations are going to involve taking the revenue we generate from our products minus the costs. We'll start by allocating direct costs to each product. Remember, the direct costs are direct materials, direct labor, and then under ABC, we also include shipping costs. Those are all costs that we can directly trace to each of our product lines. So for our purposes, these are numbers that were just given, and we would subtract them from our sales. In addition to those direct costs, we have all the indirect costs that we figured out how to allocate in part 2 of the lecture series. So for sure starts, we allocated $18.08 based on customer orders and $31.20 based on order size. For long lives, we had $27.12 for customer orders, $30.40 for design changes, and $20.80 for order size. So we're going to include those allocated costs to our individual products. And then the last step is going to be to subtract revenue minus all our costs, and that'll get us what we call product margin. So we could see that our product margin for sure starts is a positive $8,372,000, but for long lives, we're actually losing money on those long lives. 1132 is our loss. So having this information lets the company know that utilizing resources to make these long lives are actually not helping the company's bottom line. Now, does that mean we automatically eliminate long lives? Well, not necessarily. There are other things to consider. For example, some of our customers may buy a lot of sure starts from us, but they use us as a supplier because they can also get long lives from us when they want them. So eliminating long lives could have a negative impact on our other product line, the Sure Start batteries. So there's a lot of qualitative considerations and quantitative considerations that need to be considered before we make a decision. But at least we have better information from which to base that decision. That's the goal. So I'm not expecting you to say, oh, yes, we need to eliminate the long lives or not. All I'm expecting out of this chapter is that we know how to allocate costs appropriately, so then we can provide managers with better information to base their decisions. So when we add up our product margins, we get a total profit of $7,240, and you might say, well, wait a minute, this company lost $2 million. Well, remember, the customer relations and the other cost pools were not allocated, so we have to subtract those costs out to arrive at that net operating loss that we already knew the company had to begin with. So the company's losing $2 million. One of the main reasons it's losing that money based on our allocation is that the long lives are not a profitable product line. Even if they eliminate long lives altogether, they're still not going to make a profit overall because the long lives are not losing the full $2 million. So all of this information can be used to determine the best course of action. We don't have enough information to make a decision. The whole point is to say, hey, look, we have now better information than we had before. We can combine that with some additional information and then make a final decision. Customer margin is also important to calculate because I want to know not only if my product lines are profitable, but if my individual customers are. So we're going to go back to our friends at Acme Auto, and they provided us with some information. The sales to Acme Auto were $29,200, and then our direct costs, which are those direct materials, direct labor, and shipping costs for this particular customer, are also given. Those are directly traceable. Then we take those ABC costs that we assigned for customer orders, product design, order size, and customer relations that we figured out in part 2, and we subtract those out to arrive at our customer margin, which we can see is $384. So after we allocate all related costs to this individual customer, we could see that they're profitable, not hugely so, but that at least we're turning a profit by having that customer. The goal of ABC costing, again, is to provide better information for decision making. We want to determine which of our customers are generating us profits, and we want to make sure we keep those customers especially happy. For the customers that are actually causing us to lose money, we may want to decide to part ways. And this information that ABC provides will allow us to figure that out. Under traditional costing, the way we would compute our product margins is very similar, but there are some differences. So we would start with sales for each of our products, but for direct costs, we only include direct materials and direct labor. Shipping costs would be a selling and administrative cost that would be expensed in the period in which it's used. It wouldn't be allocated to individual products. Then in order to allocate overhead, we would allocate overhead usually based on a driver, one size fits all for the whole company. We could do department-wide drivers, but for our purposes here in this example, we're going to assume this company allocates its overhead based on one driver. You'll notice that the overhead allocated here, $14 million, is less than the overhead that we were dealing with under ABC costing. The reason for that is, remember, ABC includes some but not all of our manufacturing costs, and then some non-manufacturing costs. Under traditional costing, we can only include manufacturing costs. So our overhead that's included here is just our manufacturing overhead, which is all factory and production related costs that aren't direct materials or direct labor. So if we estimated our total manufacturing overhead for the year would be $14 million, and we're driving it based on one driver, in this case machine hours, we take our estimated overhead divided by our estimated activity to get our allocation rate for the company overall, which comes out to $17.50 per machine hour. Certainly that's a lot easier than ABC costing. It's one step. You got all your overhead in one big ass bucket. You take that overhead divided by one driver, and boom, you've got yourself a activity rate that can be used for the company overall. One step and we're done. Then what we're going to do is figure out the machine hours utilized by each of our products. So we can see that Sure Starts uses 480, Long Life's 320, and the next step, much like ABC, would be to take our rate times our driver. So that's what we'll do here, and that gets us our overhead allocated. Certainly it's a lot quicker and easier than using ABC costing, but we're going to get a much different result. So again, to allocate the overhead, you take your predetermined overhead rate times the actual activity. One step and we're done. So that gives us our product margin for each of our products. And then we have to take out our selling and administrative costs. So our shipping, marketing, and general admin costs don't get allocated under traditional costing. So that entire amount gets deducted to arrive at our net operating loss of $2 million. So whether you use traditional or ABC costing, the net income is the same. You're not changing that. In this case, the net loss is the same, but you're allocating costs differently. Under ABC, we allocated more costs because some of those selling and administrative costs were allocated, whereas under traditional costing, we allocate less costs to our products, which means we have a larger amount getting taken out at the end. However, under this method, we can see that we get a much different result than an ABC. Sure Starts are less profitable under traditional costing. ABC had them far more profitable, so the difference was $1,472,000. Long Life's under traditional actually look profitable, but in reality, because of all the design resources that they suck up because they're custom, they really, under ABC, were losing money for the business. So we had a far different product margin calculated under traditional and ABC costing. The idea is that ABC costing is more accurate and more reliable, so the correct or better number are these ABC numbers. So if we're using traditional costing, we're going along thinking both of our product lines are profitable, we're living the dream, when in fact one product, in this case, is far more profitable, the short starts, than the other, the long lives. So what happens? Traditional costing overcosts the short starts, which results in a lower product margin, and traditional costing undercosted the long lives, which reported a higher margin as a result. Bad information leads to bad decisions, and that's what we try to avoid. There are three main reasons why these are different. I've probably already mentioned them, but just to reiterate, traditional costing allocates all manufacturing cost of products. ABC only assigns manufacturing overhead costs consumed by the products through the various activities that are identified under ABC. Traditional costing allocates all manufacturing overhead costs using volume-based allocation. ABC uses some non-volume-based allocation bases. Remember, we were using things like the number of customer orders as opposed to just using direct labor hours or machine hours. We were also using the number of design changes under ABC. Traditional costing disregards selling and admin costs, as I previously mentioned. ABC directly traces shipping costs and then allocates some of the non-manufacturing costs to various activity cost pools and then assigns them to the products. Again, the takeaway here is that ABC costing is providing better information for decision making. Even though it's more complex to implement, it may be worth it to have that better information. To know that one of our products truly isn't profitable is something very important for managers to understand. Activity-based management is used in conjunction with ABC costing, and basically what we do with activity-based management is we use this better information in order to make improvements and eliminate waste, decrease processing time, and reduce defects. So by knowing that one of our products is effectively losing money, we could figure out potentially ways to eliminate any waste that's going into producing that product and thereby hopefully making it into a profitable one. The activity rates can also provide valuable clues as to where the waste and opportunity is, or the opportunity for improvement, that is. So if we have high activity rates for a particular cost pool, we know that we potentially have some waste going into that pool, and we can focus on reducing the cost for that particular cost pool. Benchmarking can also be used, which means we can compare our standards, our rates, with those of others in the industry to figure out if we're higher or lower and where we stand, and that can help us further determine where we need to focus our attention in order to eliminate costs and improve the overall business. Companies cannot use ABC for external reporting for a variety of reasons, but the biggest one is right here, number 3. ABC doesn't conform with GAAP, so we are not allowed to use ABC for external reporting, which means if we're using ABC costing for internal decision making, we effectively need to utilize two costing systems: ABC for internal decision making and traditional costing for external reports. External reports are less detailed than internal reports, so we don't usually figure out product margins and report it, or customer margins and report that. We're really focused on the company as a whole and reporting the bottom line income, which we know is the same under either method. It can be difficult to make changes to the company's accounting system, which is another reason why some companies don't implement ABC. I've already mentioned it doesn't conform with GAAP, and auditors may be suspect of the subjective allocation process. Remember, for our purposes, we had all those percentages given to us to figure out which costs go into which pool, but that's all based on subjective information. There's no like invoice we can trace it to determine that that percentage is actually correct. It's based on, some mathematical models and frankly some guessing. So it's going to be very difficult for the auditor to get comfort over those numbers. What are the main limitations of ABC? Well, it's a pain in the ass. So that equates to substantial resources are required to implement and maintain it. It's different than what we're used to. So, can't teach an old dog new tricks. There's going to be some resistance to those unfamiliar numbers and reports. So that's why top management buy-in is extremely important, and also making sure that employees are rewarded based on the ABC system. So there's some relationship to the system and how employees are evaluated. There's a desire to fully allocate all costs to products. So with ABC, we're not fully allocating all the costs. So some of our manufacturing costs are not included. So that may seem like it's not the best way to go for some employees. If you don't understand the numbers, you may misinterpret them, and it doesn't conform with GAAP, as I already mentioned. So you're going to need to utilize 2 different costing systems if you're using ABC. A lot of companies do utilize ABC costing. Not only manufacturing companies, but service companies as well can benefit from this system. And the reason that they're willing to incur these limitations and additional costs is because the information derived from them outweigh the cost of implementing it. So understanding the true profitability of your products or the true profitability of individual customers is really priceless in a lot of ways for some companies. And that's all there is with Chapter 7. Again, you really need to practice, especially with ABC costing, because, there's some vocab we went over here, and you can, focus a little bit on that. There'll be a few questions, I'm sure, vocab related, but the vast majority of everything in this chapter focuses on calculations. So step 1, filling up our buckets by multiplying the percentages times the costs that are getting allocated. Step 2, dividing to calculate our predetermined overhead rates for each bucket. And then step 3, allocating by multiplying the predetermined overhead rate times actual activity. So it's multiply, divide, multiply. It's a lot of math. So practice is going to make perfect. So please use the resources that are available to you on both Connect and Canvas. If you struggle through any of this, as always, reach out on the discussion boards with your questions or email to schedule a Zoom office hours appointment.